a complete trading plan for smart money concepts, step by step, so you can learn, apply, and earn. So let's jump into it. There's a few key concepts that you need to understand. The first one is market structure and order flow. This concept will help you identify the trend and how the market moves using fundamental price action knowledge. Things like identifying the swing highs and lows, which helps us identify if a market is in an uptrend, a downtrend, or a consolidation. The next concept is liquidity concepts. Liquidity is used to identify potential areas of interest, levels where most traders place their orders, key levels where smart money pushes the price into to open their crazy large orders. This will help us in identifying the smart money footsteps so we can follow their footsteps. And the last key concept is market imbalances. As we have said before, smart money moves leaves footsteps that we can follow. These imbalances are key areas where large trades have been executed. Those trades were so impactful that the market left a price imbalance or inefficiency. The market looks to always chase efficiency and balance. Therefore, the market will look to rebalance itself. In such cases, these zones give us the perfect opportunity to execute and place orders. If you are currently subscribed to our channel, you probably know about these concepts. If you don't know, I will explain very quick at the same time we're doing the charting analysis. These are following steps we need to follow in order, just like a checklist. From just opening the chart to opening the trade. So the first step, on a high time frame, usually the daily or the 4-hour time frame, we need to firstly observe by eye what is the general trend of the market, and right after, identify the main points of interest and key levels on the chart. These can be swing highs and swing lows, and imbalances like fair value gaps and order blocks. On to the next step. When, or if the price hits a key level, enter a lower time frame from the initial one. So for example, going from the 4-hour chart into the 15-minute chart when price has hit the points of interest. Now the third step, look for a liquidity sweep inside the points of interest or key levels. The fourth step, look for price to aggressively break structure and create a market imbalance. And the last step, enter at the imbalance that was validated by the break of structure in case you are looking for trend continuation, and by the change of character in case you're looking for trend reversal. This strategy can be used in two different models. Starting from the model number 1. This model indicates a high time frame reversal strategy. The first thing we should look at is an easy-to-observe liquidity grab. A liquidity grab happens when the market follows the main trend, but quickly reverses to the other side and often changes character of the market structure. When a change of character has happened, the market has likely left an imbalance in the chart, probably in form of an order block or a fair value gap. This imbalance becomes our high time frame point of interest and key level. This is the level where if price hits the zone, we will look to drop down to a lower time frame inside this certain price action. If the price does not hit the zone and continues without it, we ignore this opportunity. And if the market hits the high time frame point of interest, we drop down into a lower time frame inside that imbalance. The time frame you choose depends on preference, but as a rule of thumb, the lower the time frame, the more trades you can spot. But the trades being lower quality, giving more false signals, and the higher the time frame you choose, the less trading opportunities you can find, and the trades being more high-quality ones. The second model is easier. We are basically looking for trend continuation in the higher time frame trend. In this model, the first thing we want to look for is a break of structure in the current high time frame trend. The second action we look for is identifying the market imbalance structure in the high time frame. This market imbalance becomes our high time frame point of interest. When, or if the price hits the point of interest, we drop down to a lower time frame. Inside the lower time frame, we want to look for a liquidity sweep. After the liquidity sweep has happened, we should be looking for a change of character inside the lower time frame as a first indication of the trend reversal. After the change of character happened, we only need to identify the market imbalance in the lower time frame. This market imbalance is our low time frame point of interest, level where we look to open our trades. So let's jump into the charts. This is the gold market in the 4-hour time frame. At the first glance, we can see that the market is in an uptrend, defined by the higher highs created in the swing levels. Then it came back down and printed a change of character. However, the sellers couldn't continue to push the price down, and instead, the buyers took control again. And we can see that the market prints an internal break of structure, an indication of bullish continuation in the high time frame. And for that, we will also mark the swing high as our point of interest, because we are looking for the market to continue the main trend, as this wick to the downside has high probabilities of being a trap. This theory is also supported by the instant push to the upside as soon as the market broke down. This type of candle often indicate an increased bullish momentum, and the price broke slightly above with a wick, and the candle responsible for the break has instantly rejected to the downside. So it's similar to the last rejection candle, but in the opposite way. Now that the point of interest has been respected, we drop down to a lower time frame. In this case, to the 1 hour time frame. This market structure is clear, a simple liquidity sweep to the upside, right at the point of interest, and this sweep is validated with the following bearish internal change of character. So now, as a recap, we have identified the high time frame trend and key points of interest. Step 1 has been checked. We have dropped down to a lower time frame when the key level has been hit. Step 2 checked. We have met the requirement of having a liquidity sweep near the structure. Step 3 checked. The market either breaks structure or changes character in the favor of the reversal. Step 4 checked. And the last step, step number 5, is identifying a market imbalance to enter a setup that has been validated by all steps. And we got a market inefficiency right here. An inefficiency created by the aggressive downside push, and we look forward to short the inefficiency once refilled. Stop loss above the structure. Take profit below the current lows, and this setup gives a good enough risk to reward ratio. With the change of character validating a high probability upcoming downtrend, we look for price to pull back to the upside, fill the inefficiency, and break the past lows. Now this was a quick setup. Take profit hit within the same candle that gave us the entry. This was also supported by increasing liquidity that has been gathered by pulling back to the upside, but with a very weak momentum and strength. When candles are this small compared to the bearish ones, it supports our setup plan to take the price down even more. Another backtest, this time on the NASDAQ index. The higher time frame being the 4-hour time frame. First analyzing, and from the left we can see an impulsive upside movement followed by a few candles going in the same direction. But shortly after, the sellers started opening their positions and as well as buyers closing their positions, which led to a short-term decrease of the market. Then the market quickly recovered afterward. So this marked the first liquidity sweep on a high time frame, in a way that the price started creating internal higher highs with their internal breaks of structure to the upside, which indicated a short-term trend continuation. And what is the trend? It is an uptrend. So the expectations would be for price to continue to the upside. The second important clue is this wick. Similarly to the last backtest, this wick takes out the liquidity and stop losses from the late buyers, just to quickly reverse back to the upside, this being another liquidity sweep on the high time frame. Alright, so we were right about the continuation of the uptrend. The market printed very clear upside structure breaks. The uptrend continued up until this candle took out the high of the previous candle, and broke to the downside very aggressively. This type of candle usually leaves a market imbalance, so we might get another good setup. For that, we drop into a lower time frame, the 1-hour time frame. What we can clearly see on this price action is the following change of character, and that is strong enough to validate an existing fair value gap. Now, since this fair value gap is very large, we have multiple types of entry types. We can simply just place the sell short right at the bottom of the zone, or we can place a Fibonacci tool to the fair value gap zone and place the entry on 50% of the gap, or the 0.5 zone. They are the same levels. With this placement, you will likely miss more trades, but you might find better risk to reward ratio setups. On this backtest, I will just go the simplest way, which is to place the order at the bottom, so right at the touch. For the stop loss, we also have more options, to place the stop loss above the last major high, which will leave us with a lower risk to reward ratio, or just above the zone for a better risk to reward ratio, And for the take profit, we can place it right below the last major low in the higher time frame. That would be the first high time frame break, or we can look for the second high time frame break for an even better risk to reward ratio, which in this case, it's not that high anyways, so I will target the second break. This setup took much longer than the last one, but it's completely fine if it is closed with a win. It took some time to liquidate some other traders with this liquidity sweep, just to push it the downside afterwards. On to the next one. This is the US dollar against the Japanese yen. The high time frame is the 4-hour time frame. From the left of the chart, we can observe a concise downtrend, making their structural lower lows and lower highs, both externally and internally. After the last bearish break of structure, a significant downtrend was seen, up until a candle takes the low of the previous candle, this being also a liquidity sweep. But we won't mark it being insignificant, but we have to keep that in mind, because it respects the same pattern as it did before. Wick to the downside and the same candle comes right back to the upside, essentially increasing buying momentum, and that was seen by the small uptrend created. But this is just the pullback. We do not want to predict breakouts. And in fact, the best approach is just playing with the trend. So taking into consideration this as the liquidity sweep and the point of interest, we drop down to a lower time frame for more concrete price action details. So this is the 15-minute time frame of the same pair. We also have the line from the liquidity sweep. And the price basically created an internal higher high, which is indicative of a continuation of the uptrend in the small time frame. But shortly after, it broke to the downside. So that internal break of structure was a small time frame liquidity sweep to the upside, coupled with the internal change of character printed in the low time frame. We can have a bearish view of this market, the high time frame also being in a downtrend. So this move could be the top of the pullback just to take price down after it also did the same price action behavior in the past pullbacks. And we got the market imbalance right here, in form of an inefficiency gap. The simple setup, entry at the bottom of the zone, stop loss above the zone, take profit below a high time frame swing low. Now on the Australian dollar against the US dollar. So we covered all the major pairs. We are in the high time frame. On the 4-hour one. If we look at swing levels, the macro trend is following a sideways market. This high connects with the new high, marking equal highs. If we look at the internal price action, we can first observe a downtrend with their bearish internal breaks of structure. Then the market also did a wick to the downside at the end of the dump. This time, a huge wick, and went right back up shortly after, basically creating an internal bullish change of character. So the low time frame trend is following an uptrend. The high time frame trend is following a consolidation. The small uptrend is protected by the following higher lows. These are called protected lows, where we can see that the price did not break even one of them. All these clues leave us with the better probability of uptrend continuation in the short term. So let's see what the price does. The price has continued the short-term uptrend, as we have expected. So basically making higher highs and higher lows, while protecting the lows that we have indicated before. But now the problem is that the market has broken a swing low, also with a large wick, and the candle instantly reversed and closed to the upside. The next candle is also following the uptrend momentum. If the price would have not printed this instant reversal, this could have been a change of character. But the instant increase of upside momentum gives a higher probability of this spike move to be just a liquidity sweep to continue the uptrend. This being our point of interest, we now move into a lower time frame to analyze price action and find potential market imbalances. So we have moved into the 15-minute time frame. The spike to the downside followed by the instant rejection to the upside is seen more easily on this time frame. We want to look for buy setups instead of sells. Would anyone sell this insane, large bullish candle? That's way too hard to predict the market to that extent. We just follow whatever the trend shows us. And at the first glance, we can see the internal bullish change of character created right after the large candle broke back to the upside. On these type of candles, there are the most market imbalances found, and the one that we can find is the following inefficiency gap. So this being a buy-long setup, placing the order at the top of the zone in the simplest way possible. Stop loss below the zone. Take profit above the swing market high. We got the entry. The position has been filled. An instant rejection to the upside. This is a good sign for buyers. This takes much longer, but the setup plan was in check, so we must also have psychology plans. One of them is having patience, especially that the market plays in our direction. Great. Now on the US dollar against the Canadian dollar on the daily time frame, we can see the market has extreme wicks all over the place. This means that the market fills all the inefficiencies, basically making the market very efficient. These type of setups are almost untradeable. I was thinking to also show you what type of market state shouldn't be traded because of very slim chances for good setup opportunities. So now that you know what to trade and what to avoid, make sure to check the link in the description for a complete view of smart money concepts, related trading topics, and as well as how to change your psychology game. If you liked the video, feel free to leave a like, and see you in the next one. Have a great one, traders.